The US dollar, after reaching an all-time high last October, has fallen sharply since. Year to date, the King dollar has been the worst performing major currency after the Argentinian peso, the South African rand, and the Turkish lira. The impact of the fall of the dollar has been felt across financial markets. It has even helped cryptocurrencies recover some ground. Why has the dollar suddenly lost its appeal? The dollar has been weighed down by market expectations that the Federal Reserve is nearing the end of its rate hiking cycle, and that the Chinese economy is set to take off following Beijing's termination of its zero-tolerance policy. But there's also been an increase in concerns about the dollar's reserve currency status. Interest payment on US national debt surged to $850 billion at the end of last year, raising questions about the ability of the US to service its $31 trillion debt. Last month, the finance minister of Saudi Arabia said that the oil-rich kingdom was open to trading in currencies other than the US dollar. Meanwhile, Chinese holdings of US government bonds, which has been declining over the past 3 years, fell to just $870 billion in November, the lowest since May 2010. Is the dollar at risk of losing its status as the world's primary reserve currency? What would it take for another currency to knock King dollar off its pedestal? What is the US prepared to do to defend what the late French President Charles de Gaulle once called an exorbitant privilege? Should you be selling or buying the US dollar now? Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about major global change. Welcome to the Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, please hit subscribe and the bell button so that you'll be notified when a new video comes out. What is a reserve currency? It is a currency that is held in significant quantities by central banks or other monetary authorities as part of their foreign exchange reserves. The US dollar, the world's primary reserve currency for the past 50 years, is also the main currency used in conducting international transactions. The dollar is involved in 90% of all foreign exchange transactions, and half of the global trade is invoiced in US dollars. Talks of an imminent demise of the dollar as the world's primary reserve currency are not new. However, the intensifying rivalry between the US and China and emerging new geopolitical alliances are lending weight to the argument that the current almost total dominance of the dollar is not sustainable. But, as they say, the devil's in the details. Before we start writing the obituary for the dollar, we need to consider two pivotal questions. One, for the dollar to lose its primary reserve currency status, another currency will have to take its place. Which currency would it be, and does it have what it takes? Two, the dollar is a projection of American hegemony. How far is the US prepared to go to defend this most visible embodiment of its economic interest? By definition, the world's primary reserve currency is more widely held than other reserve currencies and non-reserve currencies. 58% of foreign reserves of central banks around the world are held in the dollar, more than all other currencies combined. 58% is greater than the US share of global GDP at 24%. This means the US dollar is stronger than would be the case if it weren't the primary reserve currency of the world. The burden to the US as the issuer of the primary reserve currency is that it has to accept and live with a strong currency, whether it likes it or not. Of course, being the primary reserve currency does not mean the dollar has always to be strong. It does, however, mean that the dollar's fundamentals have to be strong. This means, of course, good governance, economic stability, and sound finances. But strong fundamentals are not enough. The US also has to be committed to a strong dollar in both good and bad times. This is a subtle but a crucial attribute of the primary reserve currency. For the currency of any country to challenge the dollar's primary reserve currency status, that country will have to be prepared to accept a substantial appreciation of its currency. In other words, it will have to decide that the benefit of having a primary reserve currency is greater than the cost imposed by the loss of competitiveness associated with such a large appreciation. This is not an obvious decision to make. Just ask the Japanese. Japan was the second largest and fastest growing economy in the 1980s. However, a doubling of the value of the yen against the dollar between 1985 and 1995 drove Japan into a deflationary spiral that it has not yet recovered from 30 years later. A strong currency allows the issuer of the primary reserve currency to import more cheaply, but it also makes its exports more expensive. This means the issuer of the primary reserve currency has to be a large economy that does not depend on exports for growth. The status of the US dollar as the world's primary reserve currency is underpinned to a great extent by the fact that US exports are only 11% of US GDP. This compares with 18% for Japan, 20% for China, and 20% for the Eurozone. The fact that these countries and regions are much more dependent on their exports than the US means that their currencies cannot easily replace the US dollar as the world's primary reserve currency. The cost of having a strong currency to these countries is simply higher than that to the US. Of course, the fact that the US depends less on exports than other countries does not mean the US does not pay a price for a strong dollar. A strong dollar means American exporters cannot compete on prices alone. Indeed, the only way American companies can survive a strong dollar is by moving the price-sensitive parts of their supply chain to low-cost countries and focus on high value-added areas where there's less foreign competition. The result is that US manufacturing employment has fallen from 19 million in 1980 to just 13 million today. The result is that US companies today dominate markets for software, semiconductor manufacturing equipment, civilian aircraft, biotech, and financial services. US companies can compete in these markets because they are driven by technology rather than by prices. But technological changes are happening faster than ever. The ability of the dollar to retain its status of the world's primary reserve currency increasingly depends on the ability of the US to remain the global technology leader. Over the past 5 years, there's been a dramatic deterioration of the US trade balance for advanced technology products. US exports of advanced technology products have increased by only 5% since 2017, while US imports of advanced technology products have increased by 22%. As a result, the US trade balance for advanced technology products has gone from a deficit of $50 billion in 2017 to $220 billion last year. The implication, of course, is that the US is losing the technological edge that makes the US dollar the undisputed world reserve currency over the past 50 years. US policymakers won't admit it, but this is an important reason why Washington has decided to embark on a tech war against China. The objective, of course, is to slow China's technological advances. Washington realizes that what is at stake is not only American leadership in technology. At the heart of the tech war is a battle over the dollar's reserve currency status. The main benefit to the US of having the dollar as the world's primary reserve currency is that it gets to borrow money more cheaply than it would otherwise. And indeed, 33% of US federal debt is held by foreigners. The ability of the US to finance its budget deficit is highly dependent on the willingness of foreigners to keep accumulating more US debt. With so much of the world's savings invested in US assets, a loss of confidence in the US dollar would be no less than a disaster for the US. This means the US will fight tooth and nail to protect the dollar's reserve currency status. Don't get me wrong, this is not about right or wrong. No reigning champion will go down without a fight. The actions of the US over the past year leave little doubt about America's intention. In an earlier video, I talked about why prolonging the war in Ukraine serves the economic interests of the US by isolating Russia and increasing the dependencies of the American allies on the US for their energy requirements. In other videos, I talked about the US ban of semiconductor sales to China and protectionist policies adopted by Washington to bring back jobs previously outsourced to China. Regardless of whether you think these policies will be successful in safeguarding American hegemony and the dollar's reserve currency status or not, ironically, they're bullish for the dollar in the short term. Just think, given the U.S. self-sufficient in energy, higher energy prices as the result of the oil sanctions on Russia hurt the U.S. less than other countries. Reshoring of jobs will prolong the economic expansion in the U.S. and keep the Fed from cutting rates anytime soon. The tech war could set back China's ambition in semiconductor, quantum computing, and AI for a few years. America's geography makes the U.S. less vulnerable in the event of military clashes between the unipolar world and the multipolar world order. In this respect, I think not only is it too early to sell the dollar will go up if the U.S. continues down the war path. To counter the dollar hegemony, China is pushing for an independent international payment system with the RMB at its center. However, this will be successful only if China is willing to run a large current account deficit like the US. Only a large Chinese current account deficit will create enough RMB liquidity to allow Chinese allies to diversify a substantial share of their foreign reserves from the US dollar into the RMB. It is doubtful that China has an appetite for running up its current account deficit right now, while it struggles to return to the high single-digit growth. The fact that China has a very high saving rate also means that China has little needs for foreign borrowing, cheap or expensive. In other words, the benefit China may derive from the so-called exorbitant privilege, should the RMB become an important reserve currency, is not very high. Notwithstanding the rhetoric, there is no clear economic rationale for Beijing to make a serious effort to challenge the US dollar. Investors are right to be concerned about the deteriorating US fiscal picture and its impact on the dollar's status as the primary reserve currency. However, other countries are either too weak or lack compelling incentive to challenge the dollar's special status in the foreseeable future. Meanwhile, the warpath that a paranoid Washington is embarking on to safeguard the American hegemony and the dollar's reserve currency status will help support the dollar and likely propel it higher in the short term. If you got something out of this program, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, come visit us at davidwuunbound.com. Thank you for listening.